Welcome back to the MD Investor, the channel where we talk personal finance, setting goals, achieving goals, increasing our financial IQ so we can break the cycle of generational poverty. If you're a regular, you know what we do. First time, welcome. We're talking about personal finance. On YouTube with MD Investor, and let's get right into it. So today's episode is going to be a series that I'm going to start about dividend growth investing. So we're going to begin a series on dividend growth investing. We're going to go back, lay the foundation, build, and just kind of open our mind and our understanding so we can benefit from this. Number one, what is a dividend? The first time I came across this term, or a lot of us came across this term, dividend, was in the board game Monopoly. You know, you're playing the game and you roll the dice and you get the card where there's a chance and you pick it up and you say, oh, bank pays you dividend of $15. The bank will give you your $15, you know, you're like, oh, great. So most of us, that's the first time we were exposed to the term dividend. As we got older, little did we know that this was not just play money, this is real money. So a dividend is a cash payment from a company from part of their profits. Bam! There it is. A dividend is basically a cash payment from a company taken out from part of their profits. This kind of goes back or links to the video we did on being an employee versus an owner. If you're just an employee of these companies, whether it's Coca-Cola or whatever, you don't automatically just get a dividend. You may get a paycheck or salary. Only owners are entitled to part of the profits. That's why it's good to be an owner, okay? So that's what a dividend is, cash payment from part of the profits that a company paid. Number two, do all companies pay dividend? I'm glad you asked. No, all companies do not pay dividend. There are thousands of companies, right, in the world, in the US, and not all of them pay dividend. Some companies pay dividend, usually more established companies. They've been around a long time, they have grown very large, and they feel that there is not much growth potential available for them. So there is no need for them to keep all that cash back because they can't really grow that much. So usually well-established companies are the ones that usually pay dividends. So you'll see your McDonald's or your Coca-Cola, they'll pay a dividend. The other companies that don't pay dividend, they're typically newer companies, what they call growth companies. So these are companies where the management feels that the shareholder will benefit much more if the company keeps back all of the profits so they can reinvest, whether it's research and development, acquisition, mergers, to grow the company, increase value, and your share price will increase, right? Because there's basically two ways that an investor makes money. One, the company increases in value, so you bought it for $100, and the company goes up to now $200. That's capital appreciation, right? That's one way to make money. The other way to make money is with dividends. Okay, so not all companies pay dividends. Okay, but the well-established ones do. Number three, is a dividend guaranteed? A dividend is paid only if the board of directors decide to pay a dividend. So the dividend is not guaranteed. There's no law that says the company, shall pay a dividend. It's not a commandment. So the company will pay a dividend only if the board of directors decide to pay a dividend, and they make a decision based on how the company is performing. If the company is doing well and they're making profits and so on, business is good, then they'll pay a dividend. But as we've recently seen during the early part of the pandemic, lots of companies slashed their dividend. Some of them suspended it, some of them cut it. So that's a lesson to know that it is not guaranteed. The companies in the transportation, companies in the hotel and hospitality and travel industry cut or suspend their dividend. So the cruise lines, they cut their dividends because they were losing money. They're not getting income through business. So therefore, there's no earnings, there's no profit, so there's no money to get the dividend. And then when business and a lot of restaurants as well, when business came back because of the vaccines and opening up of the economy, then they begin to pay their dividend again. So dividends are not guaranteed. Number 4. And the reason why I add that because a lot of people, we're going to do these series, and part of what we're going to do is that building a dividend portfolio. And that's something you want to know. Yeah, you're building this portfolio, but the dividends are not guaranteed. Question number 4. How often does a company pay a dividend? There's varying schedule. The majority of companies, specifically in the US, pay quarterly dividends. So most of the companies that you can think of, Home Depot, Coca-Cola, all those companies pay quarterly dividend. Okay? They could be in different schedule. So they could pay on the 3, 6, 9, 12 schedule. So the dividend will be March, June, September, and December. Or they could pay on the 1, 4, 7, 10 schedule. So dividends you'll get in January, April, July, and October. Okay, so you get the point. There are a few companies that are monthly. Some companies, especially in the real estate sector, what they call REITs, R-E-I-T-S, Real Estate Investment Trust. They pay monthly. So those are good because every month you're getting a check. There are some companies that pay semi-annually, so twice a year, and there are some companies that pay annually. But most of the companies in the US is either quarterly or monthly. Some of the companies in Europe are semi-annually and annually. So obviously you want to build, and you're building your portfolio, you want to know what's what, because you want to get money every month. So if you have enough stocks, you will eventually get money every month. But that's something to keep in mind. Number 5, what is a dividend yield? So when you're studying and you begin to try to build a portfolio, you're going to come across this term. What is a dividend yield? A dividend yield is basically the amount of dividends you're getting annually divided by the share price. So if a company is giving you $5 per year in dividends and the share price is $100, that company has a dividend yield of 5%. $5 given annually, and the share price is $100. 5 divided by 100 is 5%. That company has a dividend yield of 5%. Okay? That's going to be important because that's going to determine how much money you'll get per year. Obviously, the higher the dividend yield, the more money you're going to get, right? The lower the dividend yield, the lower the income you will get. So that's what a dividend yield is. The S&P 500, which is the 500 biggest companies in the U.S., the dividend yield is probably about maybe about 1.5, 1.6%. But you have to understand that those 500 companies include dividend payers and non-dividend payers, right? They include dividend growth companies and growth companies. So companies such as Home Depot, Coca-Cola, Pepsi that pay dividend, and companies such as Facebook, Tesla, Amazon that do not pay dividend. You mix them all together, divide, I guess, by 500, and you get a dividend yield of maybe, what did I say, 1.7%? So not that great, okay? So that's what the dividend yield is. What's considered a average dividend yield? What's considered a medium or moderate? What's considered a high dividend yield? I'd say a average dividend yield is somewhere between 2 and 4%. I think that would be like an average or a normal dividend yield. Something between 2 and 4%, I would say that's considered normal or average dividend yield. Something less than 2%, I'd say that's a low dividend yield. Something above 4%, I would say that's on the higher end or high dividend yield. Just to keep in mind. Why is dividend growth important? Because if a company is giving you the same cash amount every year, right? Let's say, for example, you're making $10,000 in dividends per year. And every year you're making $10,000. Every year you're making $10,000. The problem with that is that it does not take into consideration inflation. As you already know, inflation is at an all-time high now. It's like at a 40-year high. 40-year high, which basically means your purchasing power is not keeping up with inflation, right? So inflation is normally about 2 to 3%. So your $100 can only buy $98 worth of goods and services the next year. And the year after that, it's going to be 2 to 3% less than that. So you see, inflation eats away at your money. That's why your grandfather talked about, back in my day, $100 would be able to, buy all the stuff. And now $100 can barely do nothing. So the reason why dividend growth is important is that it keeps up with inflation. So what if your company says, they're raising their dividends by 5%. They're raising their dividend by 8%. That is important because it's keeping your purchasing power above inflation. Because if inflation is only 2 to 3% and your dividends are being raised by 8, 9, 10% of a year, you are keeping ahead of inflation, right? So that's why dividend growth is important. If your salary, that's why people are feeling the pinch right now, because their salary is not keeping up with inflation. Gas is going up, food, transportation, everything is going up, but their salary is not keeping up with inflation. That's why dividends are better, because they keep up the majority of the time with inflation. Number 7. What are some important dates in dividend growth investing? Some important dates as you begin to learn more about dividend growth or dividend investing there are 4 big dates. Number 1, the first date that you're going to be aware of is called the declaration date. So we said dividends are not guaranteed, and they are paid only when the board of directors decide that they're going to pay dividends, depending on how the company is performing. So when the board of directors declare a dividend, that's considered the declaration date, right? Usually there's like an announcement that comes out as saying, Company ABC had declared a dividend of 55 cents per share, payable on this date, okay? And they usually say for company or for shareholders of record and so date. So the first date is the declaration date, the date when the company declared they're going to pay a dividend. The next date is going to be the date of record, meaning this is the date that you have to be on the books as a shareholder of this company, right? And the third and most important date is going to be the ex-dividend date. The ex-dividend date is the most important date for dividend investors. If you remember nothing else, the ex-dividend date is the most important date. And the easy way for you to remember is think of your ex-wife or your ex-husband. Meaning you were together, but now it's your ex-wife or your ex, you're no longer together. So that's how I think of the ex-dividend date. The ex-dividend date is the date in which you have to buy the company, buy the share, one business day before that date to get the upcoming dividend. I might have fumbled that, let's say it again. You have to buy the share at least one business day before the ex-dividend date to be eligible for the next dividend. So, if the ex-dividend date is May 15th, let's say for example, the ex-dividend date is May 15th. You have to buy the share at least May 14th, assuming May 14th is not a weekend, because the stock market is only open on the weekday, excluding weekend and holiday, right? So you have to be a shareholder at least one business day, not including holidays or weekend, before the ex-dividend date. If you buy the share on the ex-dividend date, because remember, on the ex-dividend date, the share is trading, it's X, without its dividend. If you buy the share on the ex-dividend date, you are not eligible for the dividend. So who is the seller? The person who sold the share would be eligible for the dividend. Because that would mean that they owned it one day before the ex-dividend date. And the next day would be the pay date, which is the date the cash goes into your account or the check gets mailed out, okay? So quickly, the declaration date is the date that the company declares the dividend. The record date is the date that you are in the books as being a shareholder. And that record date is a business day before the ex-dividend date, okay? And the ex-dividend date is the date that the stock trades without its dividend. You have to be an owner of the share at least one business day before the ex-dividend date. And the pay date is the day you get paid. So guys, I hope you got value out of this. Give me a thumbs up, give me a like, and give me a subscription if you have. We're going to continue to do videos like this to increase our financial IQ about dividend investing. It's a great way of passive income because we're trying to get multiple income streams. Give me a thumbs up and a like, subscription, and if there's people out there you think could benefit, family, friend, let them know. We're going to be doing all these series to educate ourselves as we build up our knowledge base about building a dividend income stream. Until next time, continue to command your money to grow, and I will see you on the next one. MD Investor out.